So we have looked at the economy, and we've looked at the industry, and now we're going to take a look at individual company analysis. And we do have chapters going forward that will provide more detail on the economy, on industries, and on companies. This is kind of an overview chapter for this. All right, so company analysis. So after you evaluate the economy and then identify promising industries, you finally select the securities of individual companies or of individual issuers, okay, which is companies. And you're going to use financial ratio analysis to assess the past performance of companies. How have they done? Okay, the rate. We're going to rate the jobs. To rate the jobs. I'm sorry, I'm not reading very well. To rate, we'll use financial ratios to rate the jobs that management teams are doing. Okay, so we will rank companies based on their financial ratios, and we'll use ratios to forecast the future fundamentals, the future cash flows. All right. You must also review a company's strategic and marketing plans. So you do these ratio analysis, but then you have to sit down with management and say, okay, what are your plans going forward for the company? Okay? So because we're trying to project where is the company likely to go. All right. Once you've completed your company analysis, then you employ trend and peer analysis to forecast valuation multiples. Remember that we talked about the fact that a forecast price is equal to a forecast multiple, or a forecast fundamental times a forecast multiple. So the last thing we're going to look at is forecasted valuation multiples. Once you've forecasted your fundamentals and forecasted your multiples, you multiply the fundamental by the multiple to come up with an intrinsic value. Okay? You'll then compare that intrinsic value for the stock to the current market price of the stock to determine if you invest at the current market price, can you earn your required rate of return? If you buy at the current market price and the stock subsequently, after you buy it, rises to the intrinsic value, will you earn your required rate of return? This type of analysis of looking at fundamentals and looking at valuation multiples is called fundamental analysis. This differs from technical analysis, which focuses on past stock price patterns and which groups own the stock. That's another type of technical analysis. Who owns it? Whoops. I guess there's a period there. To determine, so when you're looking at past prices and you're looking at things like sentiment, do people really, are people really optimistic about the stock, and then looking at groups that own the stock. This is technical analysis. We look at these things to determine where we think the stock price will go. Technical analysts do not look at PE ratios. Technical analysis do not look at the income statement or the balance sheet or the cash flow statement. That's what fundamental analysts look at. Fundamental analysts do not look at the stock price. They don't look to see if it's near the 52-week high or low. They don't care about that. What they care about is what does the current price look like compared to the intrinsic value. So technical analysts and fundamental analysts look at very different things. All right. Let's see, we're supposed to go through, let's make sure, through clip 20. So we've got a long way to go. All right. Studies show that most of the changes in an individual company's earnings over time are related to changes in the economy. So the economy has a huge impact on the sales and earnings at most companies and the changes in the respective industries. So the industry structure has a huge impact on how individual companies in that industry are going to do. Furthermore, changes in stock prices, not just operating results, not just earnings, are also related to changes in the economy and in the respective industries. So the stock prices also move in response to the economy and in response to the industry. Okay? In Arkansas, we have a lot of trucking companies, and you talk about sensitive to changes in the economy. When the economy is rising, you want to be in those trucking stocks because they go up 100, 200% in a year. When the economy starts to slow, those stocks will fall 75%. So you've got to be very nimble to invest in those companies. You've got to know when to buy them and hold them, and when to get out before they start falling. Okay. Multiples tend to respond more to changes in interest rates than to changes in earnings. So in terms of big indexes, it's really not, big indexes are pushed, the prices are pushed by changes in earnings and changes in interest rates. Those are the two main factors that drive stock prices in a market, okay? Changes in earnings, changes in interest rates. Which is more important? Changes in interest rates tend to be more important than changes in earnings. All right. Lastly, multiples tend to be more volatile than earnings. Multiples tend to change more than earnings change. So you got to watch that. Okay. So investors should analyze economies because of the link between the overall economic environment. So it's important to link together the economic environment and the performance of securities markets. Okay, they are linked together. Securities markets reflect what is currently going on. They reflect what people currently know. And more importantly, what is expected to happen in an economy. So current stock prices reflect everything that we already know and what we expect. And the economy is the big factor in this. All right? Both of these factors, what's going on and what we expect, are influenced by the economy, therefore a valuable byproduct of developing an outlook for the likely future course of the economy is the opportunity to integrate your economic outlook into your investment strategy. What I'm saying here is, if you will take time to consider the economy and the likely path of the economy, that should impact your investment strategy. Okay? A common approach is to use your economic forecast to determine which sectors, economic sectors in the S&P 500 to emphasize, which is to overweight or to underweight, okay, in your investment portfolio. So you look at the economy, then you look at the industry, then you look at economic sectors. There are 10 economic sectors in the S&P 500. And within each of those sectors, you'll typically find somewhere between 10 and 40 industries. Okay? So the question is, which sectors do you want to overweight? Which industries do you want to overweight? Which sectors do you want to underweight? If you overweight a sector, by definition, that means you're going to have to pick a sector to underweight. Okay? All right, so let's look at the business cycle. I'm not sure why why my animation got off, but we'll get back down to that. All right. So history shows that the U.S. economy expands and contracts in discernible periods. We see a pattern of economic expansion and contraction. So we're going to study this business cycle. Since 1933, there have been 14 complete business cycles. What is a complete business cycle? We're getting ready to look at that. It is a recovery, an expansion, an overheating, and a recession. 4 components to a complete cycle. Okay? So a cycle consists of the recovery, the expansion, the overheating, and a recession. So once we've gone through all of these, we've gone through a complete economic cycle. Okay? From 1933 to 1983, a period of 50 years, this cycle operated in a very tight and predictable range. Okay? The growth portion generally lasted about 4 years. The average recession lasted about 1 year. Therefore, a complete business cycle, for a long, long period of time, we had 5-year business cycles. Okay? But things have been very different in the last 4 cycles for these reasons. 1, the elimination in the early 80s of a few key banking rules. I'm going to sneeze. Woo! All right. Shake it off, shake it off. All right. The elimination of a few key banking rules in the early 80s, okay, freed up the economy. We changed the rules of the game. Okay? The implementation of just-in-time inventory management. Before we had computers, we did not know what demand would look like and was looking like. Okay? And so businesses tended to overstock or to understock, and this caused big swings in the economy. Now that we have just-in-time inventory management and we have systems that help us know in real time what demand looks like and what supply looks like, we don't have big inventory swings anymore. Okay? Then we had the spread of capitalism, primarily in China and in India and in Russia. We had more capitalism, okay, and so that's helped economic growth. And our central banks have learned a lot over the years, and their policies have been a whole lot better. And so because of these reasons, we have had much longer economic cycles. The growth phases of the last 4 economic cycles have lasted 8, 9, 8, and 7 years respectively. So we've gone from 4-year growth cycles to 7 to 9-year growth cycles, okay, because we're managing the economy better. Okay? So that's the end of this clip. We'll take a brief breather, a pause that refreshes, and then we'll come back and move on. Shalom. Peace.